Good morning and welcome to the Killik & Co market update. We've seen some quite interesting moves in US stock markets this week. Over the last couple of videos, we've talked about concerns about inflation going up, and that in turn has led to concerns about interest rates rising. This has led to a sell-off in growth stocks, but it has been good for some areas of the market. For example, the mining sector, which has historically done well in times of high inflation, and also the banking sector, which does well from high interest rates. So this difference in performance between different sectors has led to a difference in performance between different US stock indices. So let's have a look at the performance of the NASDAQ Composite in comparison to the S&P 500. The NASDAQ Composite is a very growth-orientated index with heavy exposure to technology. In fact, almost 28% of the index is dependent on just three stocks: Apple, Amazon, and Microsoft. So the performance of the index overall is very dependent on just these three technology companies. Over the last year, the index has done very well, as you can see by the blue line. At points, it gained over 60%. However, this week, it fell into what we call correction territory. That means it's lost 10% from its previous high. The S&P 500, on the other hand, is a much more diverse index. And in fact, yesterday, the S&P 500 hit a new record high, while the NASDAQ Composite remains down. So this really shows the benefit of having a diversified portfolio without too much exposure to one particular type of growth or one particular type of stock. Markets have been worried about rising inflation recently, so they were quite relieved this week when US core inflation data came in below expectations. Core inflation is the same as headline inflation, but with energy and food prices taken out because they tend to be quite volatile. Here's a chart showing US core inflation over the last 12 months. As you can see, the data has been falling recently. The number for February was expected to come in at 1.4, and instead it came in at 1.3. So markets had a small relief rally because that data came in below expectations, but it doesn't mean that inflation won't rise in future. This chart here shows the oil price, Brent Crude, over the last year, and as you can see, it's come up quite a lot recently. In fact, it's doubled over the last year. Oil is a key input into many factors of the economy. It impacts transport and delivery costs, and also the costs of running a factory. So even though oil itself might not be a component in core inflation, it's not to say that it can't impact those numbers indirectly. The $1.9 trillion US stimulus package has received final approval, and it's expected to be signed into law today, and this is far larger than anything that was agreed during the financial crisis. As part of the package, stimulus checks of up to $1,400 each will be sent to 85% of American adults. A lot of people will need to spend this money immediately, and that could potentially have an inflationary effect on the economy. But on the other hand, a lot of people won't have immediate need for this money, and therefore a significant proportion of it could find its way into the stock market, as we saw during the last round of stimulus checks. So that potentially could be good news for the stock market over the next few months. Moving on to have a look at next week, we've got results out from Antofagasta, Nike, and Accenture. That's it from us. Enjoy the weekend, and we'll see you next Friday.